Okay, section 11, common mistakes to avoid. Okay, so once again, when we start at section 10, mention that some of these things are going to start repeating themselves and sound redundant, but repetition is good because we're stressing some certain things that I want everybody to remember. I taught high school for 10 years and college for 15 years. One thing I learned was you could tell kids things 10 times, and sometimes on the 11th time they get it finally. So you hear some repeating of things that you've already heard. So I apologize if you are annoyed by that, but stick with me. So mistake number one, selling puts on stocks you don't want to own. So very similar to the last chapter. So the mistake is that you're looking at tickers that are popular for trading options, and they might not be the best ticker for you. They might have some nice big fat juicy premiums income. So you go ahead and sell a put on it, and you really don't want to own that stock. So you got to always ask yourself, am I okay owning the 100 shares of that stock? Because yeah, you could do a cover call immediately after, but there are times when the price may be going down a little bit and you get that stock for, let's say, $27 a share. If it goes down to 24 or 23, you might do a cover call, but there's not really any premium because when you do the cover call, let's say back at 27 or 28, because it's so far away, the premium is going to be not existent or zero. So the thing is, you got to make sure that stock long term is a good investment. So if you get stuck holding it for a while it's down, you're not going to be panicking and sell it for a big loss. So that's why companies like Amazon, Meta, Google, Alphabet, Apple, companies like that may have their down days, but eventually over time they're going to appreciate. Other stocks that you might consider meme stocks may go down and never come back up, even though they had nice juicy premium for the option trading. So once again, that's probably like the third or fourth time you've heard that, but it's very important. And you've heard this before. Choosing strikes that are too aggressive. Remember, you can look at the delta, and that will tell you approximately the percent chance that the strike price might be hit in that option trade. So as a reminder, like 0.20 delta means there's a 20% chance that that option is going to hit the strike price, which means there's an 80% chance that it won't if that's the side you want to be on. So for me, my one account, I'm selling cover calls on SPY and QQQ. I pick a delta at 0.10. So the strike price is really far away, like 4 or 5% above the current price, because I prefer that I'm not assigned and those shares get taken away. However, if I do get those shares taken away, that means the price of that stock has probably gone up 5% in 1 month, which is a pretty good month. At that point, I'm assuming that it will be due for a correction of a little bit, at which time I can buy those shares back or do a cash secured put somewhere along the line. So not all the trades I do are necessarily part of a wheel strategy. And like I said in a previous lesson, I trade a couple of different accounts differently depending on what my objective is for that account. Mistake number three, not paying attention to the earnings reports. We talked about that previously. You don't want to be in the middle of a trade if there's a good or bad earnings report, if you're on the wrong side of it. Tip number four, emotional trading. So many traders start to panic when a stock drops and the premiums change. They sometimes close out of trades too early, locking in a loss when it wasn't even necessary. I shared a story how I rolled some trades early, like a week early. If I would have waited, I would have benefited just by waiting. So remember, just stick to the plan, let time do the heavy lifting. In option trading, time is probably your best friend. Patience and time. And what I mean by time, being patient, waiting for that expiration date to get closer will make you more money. And running the wheel on volatile or meme stocks. Running the wheel on volatile or meme stocks. So I hate to mention meme stocks by name, but GameStop may be one of them. Penny stocks, illiquid stocks, highly speculative companies. So they offer high premium, but they are too volatile. You need stability. Remember, boring stocks are probably better. Another mistake, forgetting about the collateral or how much collateral you got tied up So I'll have a couple cash secured puts going, and I'm looking at some charts and some tickers, and I'm like, hey, this particular ETF is down 3%, and it's about ready to bounce off its lower Bollinger Band, and I think it's going to make a recovery. So now might be a good time to sell cash secured put. And then I look and see that I got most of my money or budget tied up in collateral with other cash secured puts. So the other problem is you might forget that your money is being used as collateral. You might want to use it for something else. So just keep an eye on your account balance, the cash balance, and what you're using for cash secured puts. Another mistake, selling covered calls too close to your cost basis. So in this example, if your cost basis is $100, meaning that you bought the stock for $100, that's what you got into it, and you sell a cover call for 101, the shares may be taken away very quickly, even with that small price movement. So this kind of caps your upside if the price would go up to, let's say, $105. Now, however, some people use the strategy of focusing more on cash secured puts. If they do get a sign, they set a strike price very close to what they got into the price, into the cost basis, because they want the stock to be getting taken away quickly so they could go back to selling cash secured puts. Don't want to confuse anybody with that, but as you get doing this for a while, you'll learn what works best for you. Also, different stocks and ETFs act differently. There's certain stocks that seem to just trade in a certain range forever. And if 101, for example, is like the ceiling for that stock, it seems to bounce off of 101 continuously to stay within a trading range. That might be a good strategy. But just remember, everybody's different. Stocks, ETFs, they all trade differently. They all act differently. Mistake number 8, trying to manage too many tickers at once. I told you that I won't say I lost track of what I was doing, but I was, when you start trading 2, 3, or more tickers at the same time, you get a little bit confused about which account they're in, when you got in, when you plan on getting out. And the other thing is, you can find just a few tickers and trade those over and over and over. And you get to a point where you can start to know that stock very well. You know what makes it go up, what makes it go down. You'll start learning how it reacts to certain types of news or how it doesn't react to certain types of news. Some stocks, when they release earnings, and the earnings could be really good, the price will go down. So recently, PayPal had a really good earnings report. I had a cash secured put and I expected the price to go up, and I stuck with that cash secured put. The price went down and it stayed down for 2 months. After rolling that forward a couple times, I got tired of waiting and I ended up exiting the trade. And overall, I lost $200 or $300 on it. However, I hardly ever lose on these trades. I usually wait out for an extra week or so, and I usually turn out in the green. But part of it had to do with me trying to expand into too many tickers and really not knowing how a certain stock would react with certain types of news. Now that I look back, I understand that PayPal, for whatever reason, doesn't have a lot of love in the stock market sometimes, even though it's a good company, it's profitable. It seems like the value of the stock trades less than what it's probably really worth. And even though it makes sense on paper that it's probably going to be a good trade, sometimes logic doesn't follow the way it should. Mistake number 9 kind of goes with mistake number 8 a little bit, where if you had option tracking software, which is a simple spreadsheet, is all you need. You can keep track of things and you can keep track of your progress, and you can also learn from your mistakes. I told you there's a section where you can put notes in. So something happened during that trade or with that trade, you can put a note in there. 2 or 3 months later, you want to trade that option again on that particular stock. You can look back and say, yes, I remember it did this and I made X amount of dollars or something like that. So keep a record of what you're doing for your own. So just make sure you keep a good record. Like I said, I've got a spreadsheet that we'll share. So something for you to start with. Mistake number 10, expecting a perfect trade every time. So not every trade is going to be ideal. That's normal. I would say very few times does a trade come out to be perfect. If a trade was perfect, I would sell a cash secured put, for example. The price of the stock would go the other direction, let's say higher. Option contract would become worthless in 2 days or almost worthless. I would buy it back early. The price of the stock would snap back to where it was, and I would do it again 2 days later and make $1,000 a week on one contract with one stock. That would be perfect. Doesn't always happen that way. Sometimes you're going to have your shares called away. You're going to have to sell. And there's times you're going to wish you would have did things differently, hung on till expiration, or there'll be times you wish you would have ended the trade earlier and locked in some profit. So success doesn't mean you have to be perfect. It just means following the system consistently. And that's all you can do. And that's going to work. So that wraps up section 11. Next is section 12. This is the last section of the ebook. There'll be some bonus videos, some demonstrations on how to do things such as setting up a chart, some sample trades, some different things like that.